The fact is that when the stock market has a major bear, everything does not go down. I know a lot of people think, oh, if you're going into a recession or depression or whatever, everything has to go down. That's not true.
You're quite different, let me add, than a lot of people on that. You have a different...
A lot of people think that, oh, if the stock market goes down, big gold's going to go down. Well, it's simply not true. A few instances during a gold bull trend, such as the bull trend from 2000 to 2011, where gold went from like $260 to 1,920. During the middle of that, there was a sharp break in October of 2008, coincident with a sharp drop in the stock market, which was already a year off its high at that. But then gold turned around and continued on up, despite the fact that the stock market took years to regain its highs. Okay. So, but in history, if you go back like early 1900s forward and look at all these big cycles in the stock market, you'll see that during that time, gold went up. No, it wasn't month by month, week by week, inverse relationship, but it was a broad investment grade opposite trend. Now, back in the 20s and 30s, you couldn't trade gold. The U.S. government came in with the wise from above and no, you can't have gold. Okay. But homestake mining was tradable, major gold mining. Homestake mining went up 1,000% as the stock market went from its 29 high to its 32 low, which was like a wipeout, 80%. Okay. And yet homestake mining went up 1,000%. Okay. Then when you go into the last 50 years since gold's been legalized in 75 and look at the bear trends in the stock market, like, for example, the stock market went into a wasteland where from an investment point of view, you didn't make any money from the mid 70s through the early 80s. Gold do then. Well, it went from $30 to 850 by 1980. Okay. Yeah. And by the way, the Fed was raising rates all during that latter phase in 1980. Did that stop gold? No. Okay. So Fed rate rises don't matter. It's the overall monetary degradation, which is ongoing, despite their flip-flops on rates. Okay. And then you look at the period, 2000 to 2002, where the stock market got cut in half, NASDAQ got cut by 82%. And in 2000, if you bought gold by 2002, it was well off the low, and it continued on up till 2011. While the stock market, as I said, like NASDAQ 100, never even made a new high above its 2000 high until 2015-16. So all during that time, gold had risen. Well, the stock market was a wasteland. Okay. Then now in recent months, however, starting from 2015, gold did start up, and the stock market was still in the middle of its bull. It was already 5-6 years off its low, but had more to go. And yet gold still went up and has matched, which people don't realize, the percent gain year to date. Gold is up as much as the stock market. And who knows, in 2 days, it might be up more because the stock market is going down and gold firming from here. Okay. People don't realize that. Why is that asset category firm? It's not exploding. Gold's not exploding. It's going up nice double-digit percentages. It's actually, as of the November close especially, you were actually up more in gold and silver than you were in the S&P and the NASDAQ. And who knows, by year-end, it may even be further.
The historical resilience of gold and silver as investment assets stands out starkly when compared to the volatility of equity markets during periods of economic downturn. Michael Oliver's insights offer an enlightening perspective on why these precious metals remain a haven for investors during market upheavals. As he notes, not everything declines during a major bear market in equities. This nuanced understanding challenges the common misconception that all asset classes suffer equally during economic recessions or depressions. From the early 1900s to the present, gold has repeatedly demonstrated its ability to hold value and even appreciate, while other assets plummet. During the Great Depression, homestake mining, a major gold miner, rose an astonishing 1,000%, even as the broader stock market lost 80% of its value. This trend was no anomaly. During the economic wasteland of the mid-1970s to early 1980s, gold soared from $30 to $850 an ounce, all while equities stagnated. Oliver highlights that this phenomenon isn't limited to bygone eras. In more recent times, the 2000 to 2002 tech crash saw the NASDAQ plummet by 82%. Yet gold began its upward march, culminating in a 700% gain by 2011. Investors who understood this counter-cyclical relationship between gold and equities reaped significant rewards while others endured massive losses. Fast forward to today, gold remains a robust performer, even as the stock market clings to its bubble-like valuations. Year to date, gold has outperformed both the S&P 500 and the NASDAQ, a fact overlooked by most mainstream investors. Despite this, sentiment toward gold remains subdued. As Oliver Riley observes, investors are all fumed and fired up about tech stocks while ignoring gold's steady climb. This disinterest in gold, despite its strong performance, underscores a broader misunderstanding of its role. Gold isn't a speculative play, it's a monetary asset with a 3,000-year history of preserving wealth. Unlike equities, which rely on corporate performance and market sentiment, gold's value is intrinsically tied to its scarcity and its role as a hedge against currency debasement. If gold is a steady performer, silver is its high-octane counterpart. Historically, silver has outpaced gold during bull markets, albeit with greater volatility. For instance, in the 2011 bull market, silver reached $50 an ounce, outpacing gold's percentage gains. While silver is currently undervalued relative to gold, this presents an opportunity for savvy investors. The industrial applications of silver further bolster its case. With over 10,000 uses, ranging from solar panels to medical devices, silver's demand is set to rise dramatically. The ongoing global transition to renewable energy, particularly solar power, underscores this trend. Photovoltaic cells in electric vehicles are already consuming vast amounts of silver, a trend that shows no signs of slowing. Oliver draws attention to the precarious state of the current equity market, characterized by extreme valuations and excessive leverage. This environment is eerily reminiscent of past market bubbles. When this bubble bursts, as it inevitably will, the flow of capital will shift towards safer assets like gold and silver. The sheer scale of leverage in today's markets is unprecedented. Investors are borrowing heavily to chase gains in overvalued tech stocks, creating a house of cards that's bound to collapse under its own weight. When that happens, the pain will be swift and severe. As Oliver notes, a sudden 20% drop in equities could spark panic, driving investors toward precious metals as a refuge. Looking ahead, gold and silver are well positioned to capitalize on the coming market correction. Oliver predicts a parabolic rise in gold prices as broader market sentiment shifts. Instead of the 3 steps up, 1 step back pattern we've seen so far, he foresees 6 to 8 steps up, 2 steps back, with silver exhibiting even greater volatility. Investors who recognize this potential now stand to benefit significantly. As the broader market loses its luster, the smart money will flow into gold, silver, and related assets, driving prices to new heights.
Nobody's noticing that. They're all fumed and fired up about, especially the tech end of the market, the leadership end. And it has all the attributes of a bubble. In fact, there's a lot of fundamentalists out there who recognize this, smell the bubble, can measure the bubble by all kinds of valuation metrics, which we don't use, and are highly suspicious. And yet, when they say that, people laugh at them. And I understand that, I've heard from some, I can't tell you whom, but from a major brokerage firm, a manager of a major office of a major well-known brokerage firm, who told me that the fever among his investors he's never seen like this before. And he said, and the leverage that they're using in the stock market is like triple, way more than he's ever seen customers use leverage in their stock position.
Wow, that's scary.
Yeah, well, maybe it goes on forever, right? Or it doesn't. But the problem is, even if that's true, the question is when. When does it actually break? That's a technical issue. But what we're arguing at MSA is we see the technicals now such that if you sneeze a little bit at the end of this quarter, as you're starting to do, and wobble, not dangerously price-wise off the high, but just enough to get you in position in relation to the new quarterly structures, momentum structure. Once you blow those, the bridge over the River Kwai comes down. And it's likely to do it suddenly, because when you ambush a bubble market, it doesn't do it slowly. They pull the rug out from under you so quickly that 20% loss very rapidly. Now, put that in context. Most people, investors, average folks, are hurting because of other factors, like the continued high prices at the grocery store and so forth, the mortgage rates and all that. But the one place they're having a good time is the stock market. So no wonder they're going crazy there, because it's working, right? Okay. So instead of being enthusiastic in 5 or 6 different aspects of there's one area they're all focused on, and they've gone nuts. When you take that asset category and you take your retirement account and take 20% off of it fairly quick, you don't have to drop a crash 30%, just say 15, 20% quickly. Pain is going to occur. And there's no place else where there's pleasure, okay? So and what assets doing well? That's when asset managers move the money flow over to the categories that seem to be doing well or have less risk, greater reward.
As Michael Oliver unpacks the interplay between market cycles, economic downturns, and precious metals, one thing becomes clear. Gold and silver are not just relics of the past. They are essential tools for preserving wealth in the present and future. The current market environment, characterized by unprecedented leverage, overvaluation, and economic uncertainty, has set the stage for a dramatic shift in investor sentiment. The result? A surge in demand for gold and silver, assets that have stood the test of time. Today's stock market is riding high on a wave of optimism, but the undercurrents suggest trouble ahead. Oliver points out that this isn't just a normal market cycle, it's a bubble. From tech stocks to speculative assets, valuations are detached from fundamentals, driven instead by euphoria and the sheer momentum of money flow. Yet bubbles burst, and when they do, the fallout is swift and unforgiving. A critical factor amplifying the risks is leverage. Oliver highlights that leverage among retail and institutional investors is at record levels, far exceeding what has been observed in previous market booms. This leverage magnifies gains during bull markets, but acts as a double-edged sword when the market turns bearish. A 20% decline in the stock market, which Oliver sees as entirely possible, could trigger margin calls and forced selling, accelerating the downward spiral. The implications for average investors are profound. For many, their retirement accounts and savings are tied up in equities. A sudden and sharp correction would not only erode their wealth, but also their confidence in traditional investment vehicles. This is where gold and silver come into play. Gold's role as a hedge against market volatility and economic uncertainty is well documented. However, Oliver emphasizes that gold is more than just a hedge. It's a lifeboat. When the stock market falters, gold historically rises, often outperforming other asset classes. This inverse relationship is not coincidental, but rooted in the unique characteristics of gold as a store of value. Unlike equities, which rely on corporate performance, or fiat currencies, which are subject to devaluation, gold's value is intrinsic. It is not tied to any government or institution, making it a reliable refuge during times of crisis. This was evident during the 2008 financial crisis, when gold prices rebounded quickly, even as equities languished. In today's context, the case for gold is even stronger. Central banks around the world are engaging in aggressive monetary easing, pumping trillions of dollars into the economy. While this has provided a short-term boost to financial markets, it has also eroded the purchasing power of currencies. Gold, which cannot be printed or manipulated, is the natural beneficiary of this monetary degradation. If gold is the steady workhorse of the precious metals market, silver is the racehorse. Silver's dual role as an industrial and monetary metal gives it unique characteristics that make it particularly attractive during bull markets. Historically, silver has outperformed gold during periods of rising prices, often delivering gains that are several times larger. Today, silver's prospects are bolstered by strong industrial demand. The ongoing shift toward renewable energy, particularly solar power, is driving significant consumption of silver. Photovoltaic cells, which are essential for solar panels, require silver, and the global push for clean energy is only intensifying. Similarly, the electric vehicle EV industry is another major consumer of silver, using it in batteries, wiring, and other components. On the monetary side, silver remains undervalued relative to gold. The gold-to-silver ratio, which historically averages around 15-1, currently sits above 80-1. This disparity suggests significant upside potential for silver as the ratio normalizes. For investors looking to maximize returns, silver offers a compelling opportunity. While physical gold and silver are the cornerstones of any precious metals portfolio, mining stocks provide an additional layer of leverage. These companies' revenues are directly tied to metal prices, meaning that even a modest increase in gold or silver prices can result in outsized gains for mining stocks. Currently, the mining sector is undervalued relative to the broader market. Despite gold's strong performance, mining stocks have lagged behind, creating a disconnect that savvy investors can exploit. Oliver predicts that as the stock market bubble bursts and money flows out of overvalued tech stocks, a portion of that capital will find its way into mining stocks, driving significant gains. Currently, the mining sector is undervalued relative to the broader market. Despite gold's strong performance, mining stocks have lagged behind, creating a disconnect that savvy investors can exploit. Oliver predicts that as the stock market bubble bursts and money flows out of overvalued tech stocks, a portion of that capital will find its way into mining stocks, driving significant gains. The potential for growth in the mining sector is further amplified by the ongoing challenges in bringing new mines online. As Oliver notes, the process of discovering and developing a new mine can take nearly 2 decades. This supply constraint, combined with rising demand, sets the stage for a prolonged bull market in mining stocks. One of the most striking aspects of today's market environment is the stark contrast in sentiment between equities and precious metals. Investors are euphoric about tech stocks, pouring money into companies with sky-high valuations and questionable fundamentals. At the same time, sentiment toward gold and silver remains subdued, despite their strong performance. Oliver sees this as a contrarian indicator. When sentiment is overwhelmingly bullish for one asset class and bearish for another, it often signals an inflection point. As the equity market falters, sentiment will shift, and the capital will flow into undervalued assets like gold and silver. This shift will be accelerated by a growing recognition of the systemic risks in the global economy. From ballooning government debt to geopolitical tensions, the factors that underpin the current bull market in equities are inherently fragile. When these cracks become visible, the flight to safety will drive a dramatic revaluation of precious metals. The question is not if the equity market will correct, but when. For investors, the key is to position themselves ahead of the curve. This means reducing exposure to overvalued stocks and increasing allocations to assets that can withstand and even thrive during a downturn. Gold and silver are not just defensive plays, they are offensive opportunities. As Oliver emphasizes, the potential for these metals to deliver significant returns is backed by historical precedent and current market dynamics. Whether it's gold's steady climb or silver's explosive potential, the case for precious metals is stronger than ever. Looking beyond the immediate market cycle, the fundamentals for gold and silver remain robust. Central banks are continuing to accumulate gold, signaling a lack of confidence in fiat currencies. Meanwhile, industrial demand for silver is set to rise, driven by technological advancements and the push for sustainability. Oliver believes that the next phase of the bull market in precious metals will be characterized by a parabolic rise in prices. This will not be a short-term phenomenon, but a sustained trend driven by structural shifts in the global economy. For investors, this represents a once-in-a-lifetime opportunity to build wealth and protect against economic uncertainty. Michael Oliver's analysis provides a roadmap for navigating the challenges and opportunities in today's financial markets. While the allure of the stock market may be strong, the risks are growing. In contrast, gold and silver offer a compelling combination of stability and growth potential. As we move into an era of increasing economic uncertainty, the importance of diversification cannot be overstated. By incorporating precious metals into their portfolios, investors can not only safeguard their wealth, but also position themselves to thrive in the years ahead. In Oliver's words, "When the stock market breaks, there's no place else where there's pleasure." For those who heed this warning, gold and silver are more than just investments. They are lifelines.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.